Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 14th of June, the middle of June. We're knocking on the door of the end of the quarter now, and Brent crude oil trading at 82.32. WTI is about $4 back from that, and we're down this morning in Asia, down about 0.5%. Market a little bit soft. It's made its big recovery from the post OPEC Plus meeting, where we saw nearly $5 drop off the market over those few trading sessions as the world digested the decision by the 22 OPEC Plus countries. But now we've come back to that sweet spot in the low 80s, but nonetheless, we're uncertain about where we go from here. Rachel Ziemba, adjunct fellow, Center for a New American Security senior advisor, Horizon Engage. Rachel, looking at all things America, I mean, I thought the market took a bit of time to digest the OPEC Plus decision, but it seems the market is a little bit uncertain as to how to read the Fed exactly. We saw the easing of rates in Europe and in Canada in recent times. The Fed held steady, but gave a kind of a mixed signal. What's the Fed? How should the market read the Fed? What's its bearing for the oil markets?
Sure. So the Fed, came out and said they're still not ready to cut. They're getting a little bit closer there. But the issue is that the US labor market is still going pretty strongly. Inflation, core inflation is slowing, but it's still there. And really, I think this is a story of different fiscal dynamics and the strength of U.S. industrial policy, right? That is still sort of kicking through. And so I do think, we'll talk today about the different drivers of why the oil price sort of, came back up after the OPEC Plus meeting. But I do think sort of some of this stabilization out of the US and other sort of dynamics, unwinding some of those bets, I think is part of this dynamic. I think this is really a story where the Fed is barely going to cut this year. It might eke out one cut. But really, the U.S. economy is still the best of the developed economies, and that really means they're not ready to do stimulus. And then, of course, you have the political pressures associated with the election. But I think this is really a macro, story at this point. And the like, and then you layer in the oil market, sort of data, and this is still a market where demand is present, but there's not strong demand out of China, which I'm sure we'll talk about, and so it leads to a dynamic where don't expect a lot of stimulus and rate cuts from the Fed anytime soon.
Matthew Wright, senior freight analyst at Kepler. Matt, does the land of shipping, freight rates, tanker rates, give us any indication as to where this market is going? They were pretty tight earlier in the year, big numbers stacked up on the back of the Red Sea disruption. But what is the outlook now as we go into the summer?
Yeah, good morning. Absolutely. So we're actually going through a bit of a period of weakness. If we start with the VLCCs, right, which are often the bellwether, or have historically been for the tanker market, we're going through a bit of a weaker period. Rates this week are sort of the weakest they've been all year. But I do think, generally speaking, we're talking from a high base. I think we still everybody is now sort of gotten used to this period of higher rates because of the situation in the Red Sea and, of course, the Russia-Ukraine. So it's a weakness from a very high point already. And actually, I don't think this is necessarily going to last very long. We've got a huge amount of US and West African crude on the way to China loading this month, because there was a huge amount of bookings last month. So I think we're going to see a bit of a tightness. We are seeing a bit of a decline in terms of Saudi volumes that are expected to go to China next month, which I think will take a bit of a sheen off it. But because we're getting those longer voyages all the way from the Atlantic basin into China, I think it's just going to continue to support rates on the tanker side. You look at other markets, containers still going absolutely through the roof. We're at, close to $20,000 a day. The Red Sea situation there is obviously the main trigger, but we've got people trying to get ahead of Christmas, well ahead now in terms of getting those cargoes moving.
Christmas is even starting in June.
Yeah, I mean, you'd be amazed at how early some of this stuff happens normally, but it's even earlier than normal now. On LNG is rising after a very, very low spring. LNG shrugged off the Red Sea situation. It wasn't massively affected in the way that liquid tankers have been, but we've seen a bit of there was an increase in demand in China. That's continuing to support those longer voyages. However, re-injection into Europe ahead of next winter, again, always thinking about next winter, is sort of helping to make sure that the balance between what's going to Europe from the US and what's going to China is sort of on a level pegging. So generally speaking, markets are moving in different directions, but focusing on the oil markets, it's high, but they're definitely a bit of a cooling at the moment.
Mark Howson, head of Asia at Wellington Analytics. Nobody better to tell us about LNG in Asia than Mark. Mark, I want to start with the outlook for the season we're in for LNG and what it tells us also about demand for energy in Asia. We've seen sort of the headlines grabbing on the big heat that's come into the summer, particularly in China and India. They're obviously the big population centers there. What's the outlook for the ability to draw on LNG spot during this peak unusual demand window of the summer heat?
Yeah, thanks for having me on, Sean. You're quite right. So obviously we're going through this big heat wave in Asia, and you mentioned China, also very much North Asia, Japan, Korea, and China as well. At the same time as that, we've actually got a particularly large amount of supply outages from normally operational liquefaction projects in the Pacific Basin. We've seen Wheatstone go down at the moment in Australia, and Gorgon earlier this year. Tangguh had some challenges, as well as Freeport as well. So that lack of supply in combination with this lack of new supply coming up this year. We only have a couple of smaller projects starting up this year, a couple of floating LNG projects, because of course the big tranche of new supply is really starting next year from the United States and also Canada. So that kind of lack of supply availability in combination with a recovering economy in North Asia, plus the hotter than normal summer, is compensating for these particularly high European gas inventories. I think they're at 72% full, which is particularly high because of the 2 mild winters in Europe. But that is very much being counterbalanced and surpassed by the demand drivers in Asia. And that's why the spot prices have been creeping upwards in the last month. We actually briefly breached $13 per MMBTU in Asia yesterday. So creeping up well ahead of the peak winter months for this little peak summer demand as well.
On that point, Mark, just to pick up on the Asia typically isn't well positioned to avail of spot prices, or because they have been locked into long-term contracts for so many decades now. What is this picture on that? How has that changed? Is it changing? And does a moment like this give us some window into that change?
It is changing, Sean, because when the market was horribly oversupplied back in 2020, obviously negative oil prices, the proportion of spot short-term churn in the LNG business represented over 40% of total transacted volumes. The market then obviously tightened up big time in 2022 with the Russia-Ukraine war. And then that proportion of spot went down again to under 35% of overall trade. Now that proportion of spot is creeping back up because of course we have got more US LNG supply in the market, which is very flexible, but at the same time the market has cooled off a lot since 2022, so a lot more spot cargoes to match some of that increased summer demand. However, you may have seen quite a few long-term contracts being signed, particularly by the classic Middle Eastern national oil and gas companies, ADNOC being one of the major ones, but
Germany,
also
of course, big buyer now.
Energy. Correct. Germany, big buyer, and Qatar Energy signed a 27-year, 4 million ton per annum deal with CPC, the Taiwanese. So a real combination of the market. Yes, more spot churn, but also more longer term deals, particularly for the projects that haven't taken final investment decision yet.
Rachel, coming back to all things OPEC and oil demand forecasts for the second half of the year, we had this week the reports out from both OPEC plus, or not OPEC plus, actually, this one is OPEC. I have to keep my track
Yeah.
of these. We've got OPEC plus, we've got OPEC, and now we've got the grade 8 countries that are doing all the cutting. So there's a few things to watch. But ultimately, the IEA and OPEC put out their monthly reports this week. There was a certain expectation that maybe OPEC would back away from the bionic 2.2 million barrel a day demand growth forecast. IEA stuck with theirs at low 1.1, 1.2. So we're looking at a million barrels a day difference between the two, which is a massive gap. We have OPEC coming out this week, just to add a bit of salt to the sauce, slamming the IEA for dangerous forecasting of peak oil demand in 2030. I just want to get your views on because at the end of the day, the IEA is an OECD research agency. It represents the biggest developed economies in the world in terms of oil and energy research. And OPEC is slamming it, and they're having a big bargee, it seems, a little bargee, let's call it. But nonetheless, it is a big dichotomy. I just wanted you to read the geopolitical tea leaves on that.
Sure, it's a big one in the sort of oil market dynamic. So add into the mix. You've had Russia coming out this week saying that they would sort of do their compensation plan for overproduction. This, of course, coming at a time when the Russian refined products have been starting to come back on the market. So maybe they will adjust on the crude oil side. I mean, I'll believe Russian compensation for past overproductions when I see it, and the like. But yeah, I think to your point, the IEA and OPEC continue to see not just long term, but shorter term, real sort of divergence in demand, and this sort of lack of clarity on some of the data and the like. I think just sort of adds to price volatility, and the like. The biggest disagreements with the IEA and OPEC, of course, continue to be about this medium-term story, right? This view on oil demand peaking and the like. But then I think you have to sort of also add in some of the other stuff that happened this week. Me, I'm always on here talking about sanctions, but this sort of was a week where sanctions and tariffs were, haven't yet been absorbed by the market, but I think are sort of hanging there. On the tariff side, we had the Europeans coming in with maybe more moderate targeted sanctions against Chinese EVs, but still ones that will likely raise the costs of electric vehicles in the European markets, adding to what the US more symbolically, preemptively did a few weeks ago. So that sort of question mark, it reinforces the fact that demand growth, both for these vehicles, but also energy mix more generally, is going to be outside of Europe, outside of the developed economies. And then you did have the US really still trying to cut Russia off from dollar transactions, as if we didn't sort of try to do that some years and months ago. But this is an iterative, incremental process. I don't think it's necessarily a full-on sort of game changer on the oil market side, but I think we will have another wave like we did, maybe a smaller one, but like we did in December, of some falling off of Russian non-energy trade, their imports, and maybe a little bit more challenges, especially for the Indians, of how to conduct the shadow fleet transactions. And so,
do you see, Rachel?
We'll
do you see anything? Do you see anything, Rachel, where on this occasion, because it's the whole crying wolf thing on these sanctions is really a kind of a dangerous scenario in some regards. I'm sure all of the compliance officers in all of the energy trading firms, etc., are busy reading the small print on all these documents. But the wider macro picture would sort of shrug this off as a nothing burger, as they say. Iranian sanctions are essentially irrelevant. They're producing and exporting as much as they can. The Russians the same. Is this an occasion where you think there's a bit more teeth in these?
So I think overall they will find ways to get the fuel to market as long as the Chinese are willing to buy. Now the challenge, especially for the Iranians, and why I don't tend to think that the sanctions are a complete nothing burger on Iran. When you only have one customer, you are subject to that customer. And especially that customer doesn't publicly admit they're buying from you. So, I mean, I'm not saying China can completely set the terms. Clearly they can't. clearly from a broad oil market perspective, to some extent, the question is how many barrels, how many molecules are on the market, right? And on that perspective, Iran is not having difficulty doing that. But I do think from a geopolitical perspective and the like, that does have an impact. Look, I think the U.S. Treasury made a choice. I think, a fearful one of saying, well, instead of actually doing secondary sanctions on foreign banks that facilitate Russian military supply chains, we're just going to extend the set of entities. We're going to almost triple them that could be subject to those measures. So I do think at some point there is a crying wolf question. They will probably have to eventually, if there's signs of violation, as I expect there will be, sanction some of these banks, whether they're in China or the UAE or elsewhere. But I do think the half-life of impact of these sanctions will probably be less. But it could have, for some weeks and some months, challenges as particularly compliance officers and folks in India is one of the sort of most vulnerable places, and some of the other market sensitive jurisdictions, even Turkey, places like Brazil that were taking some additional cargoes. So it might not move the needle in total.
As we get deeper into the election window and the noise of that sort of this always pops up as an easy thing to hit. Matt, I wanted to get your thoughts. I mean, we spent a lot of the first half of the year, certainly the first quarter, where bottlenecks competed with nearly everything else being the biggest word in the world, and we had obviously the Red Sea, which you've mentioned earlier, but we had also most notably the situation in the Panama Canal. We had the growing stresses in the South China Sea and maybe the Malacca Straits in Asia. But I wanted to get your outlook, man. And of course, all of that elevated the price in the first quarter. And I'm wondering what the outlook for all these big bottlenecks in the shipping lanes are in the second half of the year.
Yeah. I mean, very good question. I think Panama is a really interesting one because it's just not been talked about compared to what we were getting. It was a huge story in Q3, Q4 last year. As it happens, the Panama Canal Authority announced earlier this week that they're going to increase transits to 32 a day from next month because water levels have increased. So we're now in the rainy season, and looking at water levels there, they're still below 2020, 21 levels, but they're already better than last year. So they're on the way up. So the Canal Authority is feeling a little more confident. So that will have a big impact. That will affect LPG, LNG, and some clean products that transit the canal. So that's going to depress rates to a certain extent, but also reshuffle some of those trade flows. The Suez Canal, I don't think we're going to see any change there for the time being. That's locked in for another, until we see some political motivation to sort of change the situation there. And then in terms of
but ultimately on the Red Sea, Matt, that's kind of been bedded into the price, all the shipping and all of the sort of destinations and times and so forth have all kind of adapted to that longer journey ultimately.
100%, yeah. Markets are either accepting it or they're just changing their sources of supply. So, for example, on the clean products, there's not really much of an alternative for a lot of the Med and European buyers that are short middle distillates. They've got to continue to take those barrels. But for crude, we are definitely seeing a decrease in the amount of crude that's flowing east to west and west to east. You look at CPC out of the Black Sea, the Kazakh CPC. Just so expensive to get that from the Black Sea all the way around and then into Asia, which is one of the major historic buyers of that grade. So that, we up until last month, we definitely saw lower volumes of West African, US, LATAM crudes going to Asia. It's picked up a bit. So, there's definitely been some hindrance because of the higher freight. I wanted to touch on one thing that Rachel said around sanctions, and I completely agree, which is the sanctions on ships have really, when you look at the effect on Russian crude exports, there's been no impact. Russian crude exports are higher this year than they were last year. Part of that, to be fair, is because we had all of those drone strikes on refineries, which resulted in higher crude output. However, we just had the UK is just sanctioned the Russian insurer Ingolstadt. So they're almost causing more problems because that just means that no one's going to pay out when there is a spill or an incident, right? Rather than that you're going to say, oh, well, our insurer's not covering us anymore, and we won't do this. People were engaging in this trade knowing the risks. So I think we've got now 80 Russian tankers, or 80 tankers related to Russian trade, that were sanctioned in the last year alone. And Russian exports have only increased. More vessels are just continuing to fill the gap if vessels leave that trade. The Greek vessels that left the Russian trade moved down to do a lot of Venezuelan trade. Now we've had sanctions reimposed on Venezuela. A lot of them are now looking for something. So vessels will move around and fill the gaps. You know, there is no such thing as a vacuum in shipping.
And there's so many geographies and ports that are not adopting, let's just call it, the G7 sanctions, the EU sanctions, and have no sort of incentive to do so. Mark, I wanted to get your views. I mean, you're always a great bellwether for the health of the Chinese economy and LNG demand into China. We saw, you know, through the COVID window, obviously LNG demand and imports into China dropped off dramatically, as they did all over the world. And so now in the opposite side of that, the recovery of China, while obviously LNG has come back, it hasn't really sort of marched on, right? It's sort of like we've seen aviation now this summer. Aviation fuel looks like it's going to move on now after recovering from the COVID years. We're going to have a record aviation fuel market all over the world, including in China this year. But I'm wondering, where is LNG and what is the kind of bellwether is it tell us about China?
Well, it is important, Sean. And to be honest, we obviously had the big growth in Chinese LNG imports last year. And if you look, last year China imported.
But was growth
72...
or recovery or growth? Sorry to interrupt you, Mark.
Oh yeah, well I guess I'm talking year-on-year growth. So
right.
Yeah, I guess recovery since the COVID years, and we saw 72 million tons imported last year. And just to give you an indication, in the first quarter of this year, there were almost 20 million tons of LNG that went into China. So we are certainly expecting over a 10% increase in year-on-year Chinese LNG demand, taking it up to 80 million tons per annum, which would make it the world's biggest LNG importer. So yeah, we certainly see demand coming back there. And if you also look at the regas build, it is actually very considerable in terms of in China. So yeah, we see the demand coming back pretty strongly already in the first quarter, and with the big increase of supply from basically 2025 to 2029, that's when China could really accelerate away from the other competitors it has on the buying front. And
does it tell us, Mark? I mean, is it the growth in LNG to displace coal, and so there's really no net gain in terms of, you know, fueling industrial activity and GDP growth, or is it to reflect? Can we interpret any sort of macro health industrial development by the more gas they're consuming?
We very much see it driven by increased industrial demand coming back in there since the post-COVID years, and the Chinese economy. Yes, I know it's slowed down, but it's still growing at around 5% per annum. So it is genuine demand growth. At the same time, like you say, the gas is slowly eating away on a percentage basis coal's share of the energy mix as well. So I guess dual-pronged.
Two-pronged. Let's go to the survey question for this morning that we are presenting, which is kind of a sort of a tricky one. Will Brent touch $90 a barrel or $80 a barrel first? We've obviously just come up through 80 after testing sort of nearly the mid-70s in the wake of the OPEC Plus meeting, and the fact that OPEC Plus, I mean, there was many reasons why the price dropped off around that turbulent week last week, but it has recovered back above 80, and it's been sort of in that sweet spot of 82, 84 average for the year to date, pretty solid. And I'm trying to get a sense of, are we in an upward momentum here for the oil price, or could we test 80 before we test 90? It does seem the mood on that, the sentiment of that changes from day to day. Rachel, as you look forward into the Q3, we're going to obviously close out the first half of the year around that sweet spot, $83 on Brent. But your thoughts on the question and where the momentum is in this oil market, and what will sort of be, with OPEC already shown its cards and demand generally seen as healthy but tepid, what gives this market momentum in either direction moving into the third quarter?
So I think market is really going to be watching, well, obviously, so if there is really a big push summer driving season in the US, I'm a bit sort of skeptical of that. And then also how close both the sort of OPEC countries that had been, or plus countries that had been overproducing, do they actually sort of pull back now, or at the time when their peers are adding to the market? I think this momentum question as we get maybe out of Q3 is really going to be, are the macro fundamentals strong enough that OPEC actually, can add this additional supply to the market that they've promised? I think those are going to be some of the dynamics, and then we might start, more on a macro side, trading the U.S. election in a different sort of way, especially thinking through tariffs and the like. The oil market probably won't be the primary place that happens, but looking out at the sort of the rates market, the dollar market, particularly with, the Fed really being the sort of stalwart of keeping rates higher, and that's probably going to put pressure on some of the other G10 currencies as they ease further.
Matt, your thoughts on the same question? Ultimately, this market is in its sort of sticky place, but momentum in the second half. We have most research houses telling us that we're going to see a plus 1 million barrel a day demand growth in the third quarter. Would seem that with the geopolitical risk backdrop and some of the sort of choke points that you've referenced, that this market can only go higher. 90 seems much more likely now than 80, even though we're only at 82. Your thoughts into the third quarter with some of these issues and the price direction?
Yeah, I think we're more likely to stay below 90 than go above. And I think, yes, we're going to see stronger demand. We're going to hit, the seasonal, high demand in the Middle East and Asia for cooling that is really going to sort of tighten balances somewhat. But I don't think we're going to see that tightness in the market that is going to be required to push it up above that level. In-house, we still think OPEC are going to bring supply back on next year. So that's going to, we'll wait and see, right? Let's not try and jump the gun on that. But I think through the second half of this year, we're going to be at a firmer level than maybe we had expected, but I don't think we're going to see anything astronomical.
Mark Howson, last word for you, and I'm not going to get you to talk about oil prices because I know that's not your bailiwick, but I wanted to, it's not often I get you on, and you're one of the deeper thinkers in the LNG space, and I've been trying to think recently about US LNG, which of course has become such a big part of the global supply, that how vulnerable it is or isn't, given that the LNG production facilities in America are concentrated in one geographic area that is vulnerable to hurricanes and so forth. And so I'm just wanting to, speaking of bottlenecks, what is your thoughts on the midterm regarding that kind of vulnerability as the Americas and the US now becoming such a critical supplier to Europe and elsewhere?
You're right to highlight that, Sean. Obviously, when we speak to buyers and sellers in Asia, buyers in particular, they're completely focused on that. You mentioned hurricanes, but there are other factors as well, most notably that geopolitical risk we saw earlier this year from the president having a pause on new non-FTA approvals for LNG projects. And also Matt mentioned earlier the Panama Canal risk as well for those cargoes going into Asia. So significant risk there. And the way we see that planning out is that a lot of the big buyers in Asia are quite focused on incentivizing new final investment decisions from projects outside of the United States. So most notably, you probably saw yesterday the ADNOC project in the UAE, the Ruwais LNG project. And the next couple of final investment decisions could well be from non-US projects, particularly one in Mozambique from the Coral North FLNG project, as well as one on the west coast of Canada, Cedar FLNG. So again, buyers just trying to incentivize new projects that aren't subject to some of the risks that US projects are.
Yeah, it certainly will be interesting to see if those start to play into matters. But will Brent touch 90 or 80 first? This room thinks 80. We'll put that out on social media and see where it goes from here. Thank you so much. We wrap up the podcast this morning with Brent again, sort of stuck in that 82.33 number, down 0.5%, ending the week a little bit softer after a good first 3 or 4 days of trading where we had a big recovery after dropping heavily last week on the back of the OPEC Plus meeting. We're now sort of shrugging that off, all that turbulence from last week, and sort of back into the sort of average for the year. And we'll stick here, I suppose, until there's some obvious direction of travel from other factors. Let's thank Mark Howson. As always, great to have you on, Mark. And Welligen's going from strength to strength. Really impressive what you guys are doing there. Rachel Ziemba, thank you so much from US, and Matthew Wright in the UK, all looking forward to great big elections in the UK and the US, of course, but the UK is next up. UK and France, actually. The French always trying to compete with the Brits. So you both have elections. Nobody's left out of that party. All the best, guys. Have a great week. Thank you. Weekend. It's weekend time. TGIF. Take care.
Thanks, Sean. Thanks, everyone.